This is Robert Kraft, and I'm your host on SNN.Network. And with me is my good friend and frequent contributor to our channel and to our magazine and the podcast, the man, Tobias Carlisle from Acquirers Fund and the Acquirers Podcast. Toby, always good to see you, man. How you doing?
Awesome. Thanks. Great to be chatting to you, Bobby. Now that you're a new dad, congrats.
Thank you very much, man. Thank you. I don't know if you can see the bags under my eyes yet. They're just starting to form, and look, it's good for podcasting. Now I'm doing these videos stuff. I don't know. I'm shooting myself in the foot.
Yeah, it's tough, man. I've got three. My littlest is he's over two, so we're kind of almost through the diapers. But yeah, I remember it really well.
I'm still in that phase of like I very much enjoy doing the diapers. Like anything to give my wife a little bit of a break. I'm all about it. I'm sure that'll change probably after a year and like when they get more stinky. But we'll see.
Yeah, it gets real, man. It gets real. They start eating adult food, and then, whoa.
Oh man. All right. Well, you know what? If I just got to make sure I got to stay away from those that make it real bad. I can't even think of it right now. Probably beans. So no beans. And I'm going to be coming to for that for more information later because I'll definitely need help there. But first, our main objective today is you just recently wrote an article for the magazine called a Nuclear Winter for Value Investors. Now, we published this issue in the magazine back in the MicroCap review back in November 2019, and you actually submitted the original draft for this in July at the end of July 2019. So real quick, before we get into that, can you update my audience, what's your background and tell us a little about yourself?
Yeah, sure. I run Acquirers Funds, which is a value investment firm based in Los Angeles. We've got SMAs and various other things, but we've also got an ETF called the Acquirers Fund, which is the ticker ZIG, listed on the NYSE. The ETF is long, short, deep value. So we have 30 names long, 30 names short, but we're more heavily weighted towards the longs. They tend to be 4 or 5%. Shorts tend to be less than 1%. We're looking on the long side, very traditional value type style, cash-rich balance sheet, lots of free cash flows. I like to use a metric called the Acquirers Multiple, which I wrote a book about called The Acquirers Multiple, which just, it's the way that activists and private equity firms think about these valuations. We typically don't pay a lot for growth. We're trying to get things that are going through some sort of cyclical trough, but management's taking care of the business. They're buying back stock. They are generating free cash flows. And if they can get ahead through those periods where it's tough in the industry, we think that they're companies that will do very well on the other side. And it's that crisis or that industry cyclical slowdown that gives you the opportunity to buy them really cheaply. On the short side, not exactly the opposite of the longs, but because many of these companies, it's hard to work out what they're worth to the extent they're worth anything at all. But they're, very junky balance sheets, negative free cash flows. Often the thing that that to the extent that we can sort of find it, I'm always very careful to say statistical earnings manipulation, statistical fraud. I'm not saying that these things have earnings manipulation or fraud. They just turn up in the measures that we use. You would say, well, those companies must be really cheap, or those companies won't look very good. But there are often companies like Tesla fails on those tests. So the reason that they're available as shorts is because the narrative has wildly diverged from what's happening in the financial statement. So Tesla's a very good example of something like that, where financial statement's very junky, but it's kind of a narrative story stock that people like. So on top of those things, we look for broken momentum, which basically means the stock is down over the last 12 months. So Tesla would fail on that test. So Tesla's not one that we would necessarily short now, although we have been short in the past. The thing about Tesla is that you get a guy at the top who's good at telling a good story and gets believers out of investors, and he sells lots of cars too, although the growth seems to have slowed down pretty significantly for Tesla. It's only revenues are only up 2% year on year, and there's a fair bit of deterioration in the business outside of that. So that's kind of what we look for: long, short, traditional value on one side, shorting on junky, distressed, earnings manipulation and fraud on the other.
Mm-hmm. So I have to quickly follow up because I feel like this has been the main story thus far in 2020 is, and you know me, I don't ever talk about stocks on here, especially large caps, but I mean, Tesla, man, like this has just it's been wild. I mean, I can't even think of what it really can compare it to, I guess, other than very recently was the crazy run up with like Bitcoin. And for full disclosure, I do not own any Tesla shares, nor am I short. But yeah, but I mean, what are your thoughts on this so far? I mean, it's been pretty wild.
Yeah, so that spike, it's there's a lot of explanations for why it might have happened, but one of them is delta hedges. So there's a lot of activity in Tesla's options.
Mm-hmm.
So if you're buying calls, like that's rocket fuel if the stock's going up. And the people who are on the other side selling those calls to protect themselves, they need to buy the stock long. So perversely, even though they're selling the calls, which might indicate that they think that the stock's not going to go up much more from this point, the fact they have to enter in and buy the stock is one of the things that pushes up the stock. So it could be short covering by short because it's quite a heavily shorted stock. And there's also some suggestion that there's some of that naked shorting going on where folks don't get the borrow before they sell the stock short. So the amount of stock that had been reported short may have underestimated the actual short position in Tesla. So all of those things combined together gives you that explosive move to the upside, which is one of the dangers of shorting, and that's why I always short really small.
I mean, it's one of those things where I always found it kind of interesting, you know, the back and forth battle on, I mean, the FinTwit on Tesla. I tell anybody who would listen to me and say, go check this out. I mean, this is sometimes more fun than just listening to any kind of CNBC conversation, you know, but
it's mad on both sides. The longs haven't done enough work, and the shorts and that Tesla Q group, they do an enormous amount of work, but it hasn't really helped them.
I mean, it's fat. You know, I got to tell you, I actually just recently went in a Tesla for the first time. I didn't drive around it, but I actually, my buddy just got one. I gotta say, they're really cool though. I mean, a stock aside, company aside, those cars are friggin' cool.
It's a super cool car. The problem is there's an enormous amount of competition out there as well. Yeah. Jaguar, Porsche, BMW, all of these companies have got really nice high-end electric cars coming out. And I think that the thing that people love about Teslas, it turns out they actually love it about electric cars, and that's they're pretty quiet. They got a big battery, which means they sit low and they ride really smoothly. Mm-hmm. I think that, you know, that's going to be the problem for Tesla, that the competition makes it hard. And I think you've seen a little bit of that this year. Even though they've sold more cars, they haven't been able to sell them for as much, which is why the revenues are flattish year on year.
Mm-hmm. All right. So this is listen, I'm sure we could do an entire hour just talking about podcasts, but then the Tesla bulls and bears will probably come for us. So we'll save that for another time. But I wanted to get back to the task at hand on this article that you wrote. Again, it was titled "A Nuclear Winner for Value Investors." We got the original draft back in end of July 2019. We published November 2019. So real quick, what was your thesis with this article here?
So value investing has had this very long period of underperformance, and everybody who follows value knows that this has been going on. And it's unusual. It's unusual in that it has been longer than other periods of underperformance. So we've got pretty good data going back to the 20s, better data going back to the 50s, and very good data going back to the 60s. So under those different, you can analyze pretty simply price to earnings, price to book value as sort of proxies for value, like low price to earnings or a low price to book value, low price to cash flow. And then you can compare the performance of either the market or higher price to book value, higher price to earnings. And so that's what the academics call the higher price to earnings and book value, the glamour or growth portfolio, and they call the cheap price to those fundamentals the value portfolio. Over the longest data set that we have, the value portfolio has massively outperformed the glamour portfolio. But there are notable periods where that doesn't happen. So for periods of time from sort of 3, 4, 5 years, value underperforms. And they tend to happen at cyclical tops. So they happen in bull markets when all fear goes away and people are just buying the lottery ticket type stocks, thinking that investing is really easy and you always get paid, not realizing that there is a fair bit of risk in equities, and the risk is often that volatility or downside that you get a collapse at some stage. So what I just did in the article is just to look at that performance over the long term, look at those periods where it has underperformed, and look at what happens on the other side. Typically, as you'd expect, you get pretty good performance of value. The best performance of value in a cycle comes out of the bottom of a crash and through the other side. And often they will do a little bit better through the downdraft as well, because they tend to be a little bit cheaper. The unusual thing about this period is how protracted it has been. It's been an exceptionally long period of value underperformance, and it's now becoming a value underperformance that's sort of on par with the dot-com boom, the run up into 2000. And then many of your listeners will probably know that there was a very good period for value investing in the early 2000s to about 2007. Mm-hmm. So I think that there's nothing unusual about this underperformance other than the fact that it's been so long. And every time that these things happen, there's a famous Business Week cover at the very top of the last cycle where they said Warren Buffett's lost it because he's underperforming and he should have bought those tech stocks. Famously, Stanley Druckenmiller, within weeks of the top, just couldn't take the pain of underperformance anymore, hired two young guys. They invested something like $7 billion in Cisco and all of the darlings of the last go round, which were then all down sort of 80 or 90% on the other side. But that's Stanley Druckenmiller. I can't afford to do something like that.
Yeah, right. Well, what's interesting, and look, I'm not saying that any of these indicators are indicators of ends of cycles, beginnings of cycles. But what would you say? Because I'm looking at this, I'm looking at the chart from the magazine here. I'll do a quick showing real quick so people can kind of see. This is for the cheap cash flow one, and then this one's for the cheap book value. I know it's a little backwards. I'm sure everyone will see backwards, but just invert it in your brains, please. My question then here is, from 2014 on for both charts, 2014 on, I mean, you have for cheap book value is down 65%, for cheap cash flow it's down 61%. And then in the article itself, you gave some reasons for why this could be happening. Can you go through some of those reasons?
Well, that's relative performance. So that's not, they're not, those portfolios aren't down. It's just how far they're lagging behind the market. Just before I go into the reasons why, the really interesting thing. So I sent that through to you in July 31, saying this is now really unusually protracted, and it's unusual, and it's also the spread now between those most undervalued and the most overvalued is very, very wide. On August 27, that was as far apart as the spread got. Mm-hmm. And since August 27, that spread has started closing up. On September 9, value had its best day since the 2000s, since 2000. And they call that a 5 sigma event. Any market nerd will tell you that because the distribution is not normally distributed, 5 sigma is not actually 5 sigma. But the point remains that it was a very big move for value and a very bad day for momentum and growth. And then that was followed up on the next day with a 3 sigma move that was a very good move for value and a very bad day for momentum going back to sort of 2000. And that's typically what you'd expect to see when there's a regime change in the market. You see this enormous volatility. And so since then, value has been very strong. So value outperformed in September, October, November, and December. January was a little bit weaker, and so it's been a little bit weaker recently. But I think that we've now seen the bottom of that cycle, and we're likely to see that continue to perform on the other side. The reasons why it was underperforming, there are many. The suggestions were it's become so easy to screen. You can find these undervalued stocks. To that, I'd say the reason that these things get undervalued is not that there's no informational edge for value investing. That informational edge has sort of gone away. The reason that these things get undervalued is that they're perceived as being more risky. Mm-hmm. And so what you're getting paid to do as a value investor is you're getting paid to hold that perceived risk. Now, I say perceived rather than actual risk because you can go in and look at the health of the balance sheet. As I said earlier, if I find something if it's deeply undervalued, but it's got cash on its balance sheet and it's generating free cash flows, that's a pretty good opportunity. And then if in addition to that, management's buying back stock, then it's very unlikely that that sort of position is going to be a value trap because the value that remains there is getting increasingly concentrated in the shares that aren't bought back. So as a shareholder, your value is going up quarter to quarter, and that's how you're getting your return. It just eventually the market recognizes that, and that's value investing.
Mm-hmm. And because there's so much more information available to investors nowadays, you would argue maybe they're finding these at lower multiples than maybe they would have previously.
And the multiple's been getting lower and lower. So
right.
Through this period, the overvalued stocks, what defines the overvalued stocks is that they tend to have higher growth. So the glamour growth stocks tend to have higher growth. And what happens is that the multiple, that people just overpay for them, and so the multiple compresses from quarter to quarter or from year to year. So right. As a growth investor, you do in fact see that growth in the fundamentals, but the compression in the multiple means that you underperform. For value, it's the other way around. People think that these things are going to continue to go down, and in many cases, the fundamentals are going to continue to deteriorate, and in many cases that is true. But because they're already so cheap, there's multiple expansion in them, and that multiple expansion more than makes up for any diminution in the fundamentals. So those things acting together means that value tends to outperform and growth tends to underperform. Mm-hmm. This has been an unusual period though, because where typically growth sees the multiple compression, they've seen the multiple expansion. Where value typically sees the multiple expansion, they've seen the multiple compression, which is why folks have said, well, value investing's dead. It's not going to work anymore. We've got our own brand new Business Week covers. There are many, many indicators out there that are like that. But I think that that's sort of what you'd expect to see at the cyclical low. That's why the opportunity exists, because folks don't understand mean reversion. They don't look ahead far enough. And I think that we're now going back into a more normal market for value.
All right, so I'm about to ask a very CNBC mainstream financial media question, and I apologize if this is perceived to be dumb, but I think if you've watched me enough, I like to ask a lot of dumb questions. So here we go. I look at these charts, and you mentioned how there's some of these events for people that really follow the market very closely over the years. That happened back in late August and September, but if you look at the larger market, the Dow Jones, and you're seeing that it's continuing to hit new market highs. We're in this crazy 12-year bull market cycle, and I've read a few of these books that say value investing is when the greatest times to be a value investor is when you're starting to at the trough of the grander macro cycles, because that's when you're seeing, more deals and cheaper stocks. So I'm just trying to wrap my head around the correlation here where, you're seeing this, what to me actually makes a lot of sense, this nuclear winter, because it's just the grander market continues to reach higher and higher levels. But yet now you're saying that it's starting to turn, but the market continues to keep hitting these higher and higher levels. So how would you answer that?
Yeah, ordinarily, the first thing that I would say is that value sort of follows its own idiosyncratic path. It doesn't necessarily do what the market is doing. And the last few years are a pretty good example of that, where the market has been very, very strong and value has been weak to soft, like not participating for the most part in the rally. And I think the reason for that's pretty simple. Value investors tend to be pretty disciplined, tend to look at the downside risk as either look at the downside risk or look at the downside risk first, which is what I tend to do. How much can I lose? How much can I want to make, they say you want to make sure of the return of your capital before you worry about the return on your capital. So that's a value. So the bid goes away for value closer to the top of the bull market. And then when things get cheap, all of a sudden the value investors are very active and buying stuff. And that's when the bargains are available. And so that's when you see a lot of the performance following on from that value works really well. I would say that value will do very well out of the bottom of a bust, but it doesn't require a bust. And I think that the early 2000s is a reasonable proxy for what is happening now. I actually think that the market now is a little bit of the market now unfortunately has the worst aspect of both the 2000 top, which was a valuation issue, and the 2007 top, which was a credit crisis. And so the 2000 bust was just a valuation bust. That was basically the expensive stuff got smashed to pieces, but the value stuff, because it was very undervalued, actually went up through the bust. Mm-hmm. So value didn't go down in 2000 and 2001 and 2002 because value had had its bear market already in the late 1990s. The value stocks were going up through that period.
Right.
So long-only value investors, there are lots of long-only value investors who are famous now because they were buying in 2000 and doing very well through that period. 2007 was a different story because the value had had such a great run. Value had turned into a momentum strategy, and value, paradoxically, was more expensive than growth, if you can wrap your head around that one. So what happened was...
Again, not smart enough, so I just want to make sure that's clear.
It's crazy to think about, but value was so expensive in 2007, it was more expensive than growth. Mm-hmm. And if you'd been a value investor who looked at strategies as well, you would have said, well, probably you don't want to be a value guy here, you want to be a growth guy here. And you might have seen that, like you could have seen that in the forward PE. The forward PE of the value portfolio was higher than the forward PE of the growth portfolio. And so that's part of the reason why growth massively outperformed over the last decade plus, and value has underperformed. It's been getting back to those more traditional discount that you should get for buying these riskier stocks, perceptively riskier stocks. So now we're in this position where the market is extremely overvalued. There are really not very many pockets of undervaluation, and you also have this, this enormous amount of money printing and so on going on. So there's some possibility that there's some credit risk in some of these stocks as well. When the collapse came in 2007, because those value stocks were so expensive, they were down as much as the market was. So there was no protection being in value. This time, value is not expensive, but it's not cheap either. It's roughly at its long run mean, or a little bit rich to it. The growth stocks are extremely expensive, more expensive than they've ever been, barring the very top of the dot-com boom. So I think growth is going to come back 80 or 90% when we see the next bust. I think value could come back 50%. The market will be down a little bit more than that. The market could be down 55, 60%. So I think value will slightly outperform, but not by much. Mm. That's why I think you need a long short implementation going into something like this, because you need to be able to capture that short on the growthier, glamorous stuff. When that comes down, that's going to pay off really well. And then value itself could still see a drawdown, but not as much as the market. So that's why I'm long short, because I think that there's something like that coming. I don't know. I'm not predicting it. I can't tell you when. That's every value investor will tell you that. I can tell you that something's undervalued, but I can't tell you when the market's going to recognize it. I can also tell you that something's overvalued, and I don't know when the market's going to recognize that either. But that's what I think is going to happen.
The next logical question that I'm sure you get asked at every cocktail party and networking reception, and probably when you're a guest on someone else's podcast, but I'm going to put my CNBC host hat on again and ask you that annoying question, because I like to be annoying sometimes. And it's, for you, what could that event or series of events be that could lead to some of these drawdowns that, might end up happening, that a lot of people are thinking will happen?
It's tough to predict. I've learned over a couple of decades doing this stuff that I have no idea what is going to be the catalyst for the market. I mean, if somebody had said to you 10 years ago, this is the valuation of the market, so on a cyclically adjusted PE basis, it's going to be over 30. And if you look back, there's very few occasions when it's been over 30. It's like 29 and 2000 really get over 30, and 2007 over 30. So those are the only times when it's as expensive as that. And then they say there's going to be a trade war, coronavirus, which is going to be crippling the biggest trading partner that the US has, or the manufacturing partner that the US has, shutting down that country. what do you expect the stock market to do? I mean, would you say the stock market will be slightly up through that period of time? So you'd never predict something like that. And then you say to someone, where do you think interest rates are? And they'd say, I don't know, 6, 7%. They'd say, no, they're closer to 0%. That's why macro is so hard. Oh, and there'll be negative interest rates in Europe as well.
Yeah.
So I think that just shows how hard it is to predict and see where all the moving parts are. So I have just learned that I'm better off just ignoring that stuff because I have no idea what any of that is going to mean. And I think that we don't even know what causes collapses after the fact. That 87 collapse, which everybody said, that was program trading. That was because that was the first time that we had access to futures and people were able to hedge their equity exposure in the futures market by selling futures. And then they said afterwards, well, that was because it caused this cascade of selling as people were trying to hedge further in the futures market. That pulled down the futures market, which pulled down the stock market too. But the guy who was the head of the NYSE at the time, Michael J. Fallon, he wrote a report that came out the other side and he said, that's not right. There were sort of 5 possibilities for the reason why the market fell over at that time. And program trading was like the 5th thing that he identified. And this was his report after the crash. I think that it's extremely hard to know, even in the past, what caused the crash. So I think that it's harder still to predict what will be the cause of the crash in the future. I think sometimes, these complex adaptive systems, they go in one direction and nobody knows why, and then they turn around and nobody knows why. Why does something collapse? It collapses because it gets too high.
Mm-hmm. Well, I mean, I guess we'll see at this point. The reason I even ask that question is because, especially, look, in my career, I haven't even been through a bear market yet. I mean, I got started in this business back in 2011, and the last big one was 2007, 2008. And from everything I read, and there's movies about this, it seemed like there was at least a small amount of people that understood, like, hey, this housing crisis, this is about to be a bubble, But what's interesting about what's happening right now is we have more access to information, more data on historical events than ever, and yet, I get very similar response as like, look, I know of all these things that could happen, but as to what it could be or imagine what it could be, I don't know. It's pretty interesting.
The funny thing about that housing market crash is I've since, like, when I saw the crash in real time, I read all of the Big Short and The Greatest Trade Ever and all of those books that were about the crash. And I was like, well, you should pay attention to these guys. And, Peter Schiff's out there. He's always bearish. Hussman's out there, pretty bearish. Probably they've identified the cause of it, but the actual timing of the collapse makes fools out of everybody because it happens 5, 6, 7, 8 years after you start making that prediction, and you look like a fool for the nearly decade while it keeps on going up after that. I've spoken to people who knew some of the folks who are in these books, and they say, that's the thing that these guys did was they were just the last in a long line of people who had been making these predictions and had been putting these trades on. So there's one guy in The Big Short, or I think it's The Big Short, where he'd worked at Dalton. He worked at Dalton, which is a big firm in Los Angeles here, and he had been putting these short trades on. He got fired from Dalton because they were like, we can't have this. You're losing 1 or 2% every year in a market that's charging on. What are you doing wrong? You're gone. And then he went out and set up for himself, and he caught that crash almost immediately. There were lots of other guys who had been trying to do the same thing who just kind of ran out of time or ran out of money. So they were right, but they were right in 2005 or 2006. You needed to be right in 2007 to get paid. And that's why it's so hard.
So hard. Well, with that, man, I know you're busy. I know you got a lot going on there. Any parting thoughts? Any upcoming guests that we can be excited about to hear on the podcast soon?
Well, I just say I'll be on Real Vision sometime in the next. I'm not entirely sure when it comes out, but I just recorded that in Austin with my good friend Chris Cole. Cool. And so I'm really excited about that. If folks want to get in contact with me, I'm on Greenbacked on Twitter, which is GREENBACKD. My website, I have a website where you can get a free screen, acquirersmultiple.com, and there's a small MicroCap screen in that you need to pay for. And I have the firm is Acquirers Funds, and that's acquirersfunds.com. And the ETF, the ticker ZIG, the Acquirers Fund, and you can find that on acquirersfund.com.
Sounds good. And real quick, because I didn't ask you right as it happened, Tesla owner, short, any position?
Yeah, we have a short in there, but we'll probably be rolling out of that. It's been a very painful short, but it's a very small position, so it's hasn't hurt the portfolio so much, because I think I like to short as a portfolio. So if we see any of the weakness potentially that I was talking about in the market, you hope that protects you more than just an index short. But yeah, we've got a little position in it. Hasn't worked out. We'll probably be rebalancing out because it no longer meets our negative momentum weakness requirement.
Gotcha. Dude, I'm so sorry. I didn't want to leave you on that note, but so any vacations coming up, or what do we got going on?
No vacations, but I'm super excited about, value investing in the market. And I'm big congrats, man, once again on the first addition to the family. That's really exciting.
Dude, thank you so much. And thank you as always for joining me, and we'll talk again soon.
Awesome.